Welcome to Investors Insights. Our topic today is hyped up emotion. With all the headlines that are out there, inflation, supply chains, will they renew Jerome Powell as chairman of the Fed? What's going to happen in interest rates? Could we see interest rates going up? All of this hyped up emotion that's taking place throughout the past vlogs, we've tried to bring you up to date on what's actually taking place behind the scenes. And I'm joined today with my great colleagues, Adam Van Zant, Ty Miller, and Trey Booth. And we've just finished a great meeting. Guys, really look forward every Monday, starting the week off to our meetings. And I also need to say to our viewers, we continue this dialogue throughout the week on our social media, on LinkedIn, Twitter, Facebook, and our podcast, which we continue to expand on. So with that said, let's start off with hyped up emotion. Trey, put some confidence, take the anxiety down for us here, because you talked about strong jobs this morning. So talk about that.
Yeah, thanks, Greg. So last week was a big week on economic news. We had the Fed meeting discussing tapering. We had the jobs data. We have been hyper-focused on jobs since the recovery began, because that's what the Fed told us they were hyper-focused on. And the Fed stimulus has been a huge tailwind to the stock market over the last nearly 2 years, really 18 months. And so how the Fed reacted to strong jobs data, how the market reacted to the Fed tapering was going to tell us a lot. So what happened last week? The Fed announced they were going to reduce bond buying from $120 billion a month by $15 billion. So that should take them around 8 months to get down to no longer providing stimulus if they stick to that path. Then after that, we got a strong job data of 531,000 jobs were created in the month of October. That's a great number. And you can see on this chart that it's much higher than the previous month, still well down to where we were in the midsummer. But what we were concerned by is a very negative trend, that this report completely flipped. And so we're going into the fourth quarter with what appears to be a stronger economy. And the market liked that. Now, the reason that's positive is that often the market in these times of transition, where we're going from easy monetary policy to a hawkish monetary policy, we'll see this tailwind in the market when there's good news becomes bad news, where we'll see good economic data and the market will fall off because that means the Fed may raise interest rates. Well, we got good economic data. We got a Fed that's pulling back a little bit of stimulus, and the market continued to rally. That shows that maybe the economy is close to standing on its own 2 feet. And that's a positive sign for long-term market strength. You can't have a pure stimulus-driven economy. And so this transition in these jobs is very good information. On top of that, we still have a lot of jobs to add. And so there's more growth in front of us. This chart shows where we were in total employment before the pandemic. We still have millions of jobs to add. So that's additional GDP growth potential that's out there. And then we also saw on the next chart, you'll see we saw average hourly earnings go up. That's good. That means that these new employees are coming back at higher paying jobs. So that's more money in the economy, more money for consumers to spend. All that's very positive and could give us more legs into next year and potential growth.
Well, and it's well said on multiple levels there, Trey, as you talk about how everything's tied together. You did a great job on that, explaining it. And we are getting phone calls and meetings with our clients that are going, what about inflation and all these other topics I brought up at the beginning of this vlog? And the reality of it is we're still seeing a lot of behind the scenes growth taking place, a lot of strength in this market. So it's well said what you've done there. And then on the inflation, people are saying to us, Greg, we're paying more for this. I'm having to pay more for this on the construction side, those kind of things. But Ty, you brought up a great point, in regards to supply chains and tariffs, which ties into the strength that Trey's talking about. Just elaborate on that.
Yeah. Thanks, Greg. So as you and Trey alluded to, the economy does appear to be strengthening up. Last week was the G20 summit in Rome, where the U.S. and the EU agreed to do away with their tariffs. So the U.S. is stopping tariffs against the EU for steel and aluminum. We know what kind of supply chain issues we've had, so we're trying to get that corrected. And the EU, in response, agreed to end their retaliatory tariffs against us on some of our goods. And they were supposed to put some new ones through December 1st. They decided not to do that as well. So expect some more talks with Japan and the UK on our behalf regarding the same kind of things, steel and aluminum tariffs, but don't necessarily expect anything with China anytime soon, as we're still working out some issues there. But with that being said, we're trying to get these supply chain issues fixed, and this, on top of the infrastructure bill, should really help do that.
Yeah. No, we fully believe that. So again, hyped up emotion. Could we look up in about 6 months from now and some of these issues that everybody's starting to bring up are actually non-events? We're going to keep a close eye. We're always looking to see what could blindside the markets to cause more volatility, and we're going to keep everybody informed. And then with technical analysis, we're watching it very closely to see where institutions are buying, as well as from the standpoint of the economic trends. So Adam, tell us about the strength of this market in relation to the resistance and support levels that we're seeing out there now, because every week we continue to move those up. Do we stay paranoid? We do. But at the same time, we're watching that strength. So talk about that.
I appreciate it, Greg. And yeah, last week, Bobby elaborated that historically, November has been a very strong month for the markets. This at least held true for the first week of November, with the S&P 500 close coming at 4,697. That gives us a new resistance level of 4,730 with a new support level of 4,670. We also see the year-to-date moving average sitting currently over 4,200. To be exact, that's 4,202. So we heard some of these data points from Trey with good job support. We also have 90% of earnings coming in. We also are looking at the Fed tapering. So in looking at all these fundamentals, they are actually coinciding in a good way back to technical analysis. And we're going to see if we can keep this momentum going through the end of the year.
Yeah, these are things that the bears grab for in terms of hyped up emotion, hoping that this would bring the market back down. As I said earlier, we stay paranoid and make sure that we're watching every aspect to see what could cause the volatility. But technical analysis with a combination of fundamental analysis and then tying it to our clients' financial blueprints to see where they are, if they're ahead of schedule on their goals, that helps tremendously here at Five Plan Partners as we try to help people have better, richer, fuller lives. We hope you have a great week, and we will continue to keep you updated. And just know that we're watching the headlines, but we're also watching the data behind all those headlines to see what really is going on. Thanks again. Talk to you soon.